First, thanks for the organizers for having me here. This is a fantastic conference. I'm Kristina Molnar. This is joint work with Florin Bilbiie, Refet Gürkaynak, who's sitting at the back, and my fantastic colleagues from Norway, Mathis Mæhlum, and Sigurd Galaasen, from whom I learned a lot how to work with Norwegian administrative data. The title comes from the Hank literature. So we are speaking to the kind of models that Antonella is working with. I lost the microphone. Thank you so much. Thank you. And what we're doing is we're providing sufficient statistics out of Norway. That's the SON part. That's why it's HANKSSON. So we macroeconomists, we are interested in the aggregate. But how do we aggregate and how do we write models for the aggregate? That's not such a trivial issue that has been on the table since the beginning of macroeconomics. We have a relatively good idea of how, for example, individuals choose consumption linked to their disposable income. That's what I have here. Oops, here. But can we write the same thing in the aggregate? That's not that trivial. There can be all sorts of issues. First, the consumption function doesn't have a closed form solution, right, typically. There can be non-linearities. How do we aggregate then? People can be heterogeneous. So for a while, the literature focused a lot on mainly the mathematical part of this. What are the conditions under which we can aggregate and then write a representative agent economy? In the recent macro literature, in the Hank literature, they have a very different approach. And they say, well, instead of aggregating upfront and writing down a representative agent, let's embrace heterogeneity and aggregate ex post after optimal choices have been made. But still the question remains what types of heterogeneity we should focus on. What are the relevant dimensions of heterogeneity that we should focus on? And a key finding in this literature, it's still an ongoing literature, but in the last 10 years there was a lot of improvement and a lot of new theoretical results. A key concept is that this covariance matters a lot. So if I look at whose disposable income changes the most, and what do they do with that disposable income, how do they respond with their consumption to that disposable income, that matters a lot. And if this correlation is positive, then heterogeneity can have a big impact on the aggregate. So that's an important dimension of heterogeneity. But there are all sorts of issues, mainly measurement issues. Namely, we don't observe consumption. We don't observe disposable income, typically. Consumption we don't observe because normally what we have is consumption from a survey, which has noise in it. Or even if we have administrative data, like Fageneng's work in Norway, for example, we have to impute consumption. So we don't, that's expenditure. We don't know actually what they have spent. We don't observe disposable income. Typically, we work with labor income because that's easier to observe. But that's not the only component of income, and disposable income is really what households use as a state variable, right? And then, of course, there are all sorts of dimensions of heterogeneity that are relevant for this choice that are also difficult to observe. So in this paper, we have the privilege to observe all of these and make some measurements. So our motivation is that this interaction that Antonella has spoken about as well, that heterogeneity impacts aggregates, aggregate shocks impact people heterogeneously. There's a continuous interaction between these two, and in equilibrium, something shapes. And we'd like to ask whether this is salient in the data. So the question in particular that we're asking is, does heterogeneity amplify aggregate shocks? So at the end of this interaction in equilibrium, does heterogeneity have a role, amplification role, over and beyond what the aggregate shock is causing? And which dimensions of heterogeneity matter? We use a joint distribution of income, wealth, consumption, household characteristics. And we provide measurement with a very simple organizing theory. Our approach is to provide sufficient statistics, perhaps a bit of a strong word to say sufficient statistics, but what we do is we use totaling, we ask what is the impact of a 1% total income change, let's say there's a recession, for example, on aggregate consumption, decompose this to the individuals. Who is most impacted, whose income falls the most, how do they respond with their consumption? We estimate their MPCs and calculate the MPC distribution for Norway. And then we derive sufficient statistics for aggregation, basically talking about this covariance that I had on the first slide. And then, even with perfectly insured households, there might be heterogeneity. They might make different decisions about how to save, what kind of assets to hold. So in the second part of the paper, we, instead of calculating MPCs, MPC calculation also has all sorts of issues. We look directly at the impact on consumption. And we have a case study looking at the biggest recession that happened in our sample, which was the Great Recession. Today, for the sake of time, I will focus on the first measure, also because that's a model-free measure. We find that if you look at labor earnings, like the literature has done, then there is amplification. And income risk and cyclical inequality is important for that amplification. But if you look at this, if you use disposable income, there's no amplification. And we even find a moderate dampening role of inequality. And here the key is the other components of income apart from labor income. And finally, when we look directly at consumption, we find some amplification, but very, very mild. And here, the key terms is how households make precautionary savings, how they save in liquid assets. We contribute to three branches of literature. Our contribution is in the measurement. We contribute to the HANK literature. We use their framework to frame our measurement. We estimate MPCs. There, our contribution is that we can see the actual consumption. And we also contribute a bit to this massive literature on inequality. Here we have better metrics of individuals and households, basically. So let's look at the sufficient statistics. What we are interested in is amplification, which is very easy to explain when we have only one household, representative agent. So let's take this very simple example. Let's assume consumption is some function of income, interest rate, and some other things. And there's a, let's say, contractionary monetary policy shock, interest rate changes. Then we just have to take all the derivatives of this implicit function. And the direct effect on consumption is the last component here, direct effect of the interest rate on consumption. But the interest rate also changes income, and households respond with their consumption to income. Extreme case, let's say there's no taxes, there's no government, closed economy, income must be equal to consumption. We can substitute that in. And there, what you get is, apart from the direct effect of this interest rate change on consumption, there's an amplification, there's a multiplier in front that depends on what we call aggregate marginal propensity to consume. Here there's only one individual, of course, but the amplification comes from the fact that this household increases consumption, that increases input, that's an earning for the household consumes that input, and so on and so forth. Now, as soon as you have two agents, this is not so simple. So I will not talk much about it, but Florin has a paper where with some strong assumptions, he's able to derive some closed-form solutions. Here what you see is if there are hand-to-mouth households who just consume their income and savers who can do intertemporal smoothing, then the direct effect depends on the share of savers because they are the ones who can move their consumption. But the multiplier depends on the hand-to-mouth households, and this beta is how their income is responsive to a recession, let's say. So it's because when the savers increase consumption, that turns into output. That's an income from the hand-to-mouth households, and the MPC of hand-to-mouth households is 1, basically, theoretically. They are the ones who eat everything they receive. So the amplification depends on them. But of course, there are strong assumptions in this, so we have a more general formulation. So what we do is we calculate aggregate marginal propensity to consume. What's the change in consumption when aggregate income changes? Well, we can just sum up all the individuals. First, let's say there's a recession. This will load differently on different people. This is what Gürkaynak calls income beta. This we calculate in percentage terms. So this is log derivative. Then these people will change their consumption. That depends on their marginal propensity to consume, which is also heterogeneous. And when we add them up, we have to take into account their income share. So this is a model-free metric. You can rewrite this as sample-weighted average of these income betas as an average marginal propensity to consume that we calculate as assume everybody's income beta, income sensitivity to the recession is the same. So we just take the average multiplied with their income weight. And then the covariance between their marginal propensity to consume and their beta, income beta, sensitivity of their income to a recession. And we have amplification when this covariance is positive. So exactly those people change their consumption the most whose income has declined the most. Or another way to look at it, when the average marginal propensity to, when the aggregate marginal propensity to consume is bigger than the average. So let's get to the data. The Norwegian data is very nice. It's high quality administrative data. There's a wealth tax. So we know the wealth of people. And importantly, this wealth is reported by third parties, financial institutions. So if I take up a mortgage, the tax authority would see exactly how much mortgage I took, what's my deposit, what's the debt that I have on my account, and this is reported by the bank. And when I file my tax return, all I have to say is the numbers that are already there, are they correct or do I want to add something? Income is also high precision because it's reported by the employer. And then taxes, and we see taxes and transfers and capital income as well. We use working age population and we see household characteristics, what kind of sector these people work as well. The new data that Norges Bank purchased quite recently is the so-called transactions database of consumption. So this is data that's coming from one of the biggest clearing houses in Norway that's cleaning 80% of the market. So for 80%, we see what they spent on their debit card and what transactions they did on their bank account. We don't see cash payments, but Norway is a more or less cashless economy. And then consumption is debit card payments, bill payments, so payments, bank transactions to another entity, and we exclude consumption from housing. This is how the aggregate data looks like. The red one is the national accounts. The blue one is our consumption data. You see that as time goes on, we go closer to the national accounts. And if you look at first differences, the two are very correlated. So the first thing we do is we estimate these income betas. We do nothing fancy. We follow a paper by Gürkaynak, and we find something that's very similar to what he finds. So we estimate, we put labor income here, and estimate what's the loading of aggregate income change on labor income, and we estimate this for groups. The groups are based on individual characteristics and past average earnings. And what we find is the same. So this looks very similar in the US. Those at the bottom of average earnings, their income is very sensitive to aggregate income changes, and those at the top is also very sensitive. Heterogeneity analysis across age and gender is also similar to the US. Then we estimate MPCs. We do that also for groups. So we take our consumption data, and then we take the change in disposable income for households with characteristics X, where X contains age, gender, lagged income bins. So we estimate this coefficient, controlling for time and spatial controls. But of course, the income change, this in disposable income, that's not an exogenous shock. So what we do is we instrument that with the shock of becoming unemployed. So if you were employed in the previous period, now you're unemployed, then we consider this as an income shock to you. Advantage of this is that we can then calculate MPCs for the whole population. Disadvantage is that this is not a clear transitory income shock. So, okay, this is how we impute MPCs. As a robustness check, we use the Jean Como version of the Blondel-Pistafari-Preston estimate to counteract the fact that this is not a clear exogenous shock. That's a semi-structural estimator using time series and cross-sectional patterns of income and consumption. This is how the MPC distribution looks like. So the first thing to note that the MPC is average MPC is quite big, around 0.3. And there's a lot of heterogeneity. There are not so many people who estimated the distribution of MPCs, but this is quite a general message on US data as well, that there's a lot of heterogeneity in MPCs. Then what we do is we put these people into MPC bins, so take bins from this distribution, and then re-estimate this income, given a type of income beta, their income sensitivity. Before showing you those results, let me show you some heterogeneity. Sorry for the small fonts here. The only thing that really seems significant is education is an important driver of MPC heterogeneity, and those with low education have higher MPC than those with high education. And when we group households into hand-to-mouth, non-hand-to-mouth, using the Kaplan-Violante measure, which is based on liquidity being smaller than 2 weeks of income, then those who are hand-to-mouth also have higher MPC. So let me show you the estimations for the MPC bins. So first we do exactly the same as what Kristina Pettersson already did in a paper. Here on the horizontal axis, you see the MPC deciles. So from the MPC distribution, we bin people into these deciles. We estimate the sensitivity of their income to a drop in GDP on the left-hand side or a drop in average income from our data on the right-hand side. The pattern is the same as Kristina finds in the US. So exactly those who have high MPC are the ones whose income, labor income, is most sensitive to a recession. So that would generate a lot of amplification. But here's what you find with disposable income. It flattens out, even turns around. So now those who have low MPC, so they don't really respond to an income change, their disposable income is the most sensitive to a recession. So let's decompose this because we see all the components of income. This is if we add capital income. And you can see that for those who have low MPC, if you add their capital income and their labor income, their income becomes more sensitive to a recession. And then if you have taxes and transfers, they are the ones who are paying most of the taxes and receive least of the transfers. And the opposite is true for the high MPC people. They receive a lot of transfers and pay little taxes. And this redistribution is actually important for household decisions. So is this just Norway? Of course, in Norway, there's a lot of redistribution. So what we do is we take our data, but now impose US taxes and transfers on it. And what we do is we use Axel Ferrier's estimate that has a flat capital income tax and has an estimate for both taxes and transfers. So first we estimated on Norwegian data. Here's the blue line is Axel's estimate. On the horizontal axis, you have labor income. And the red line is Norway. So you can see that those with high labor income have higher taxes in Norway. And the reverse is true for transfers. If I bin people into labor incomes and plot the data, that's the blue line. The green line is our estimate for Norway, just to see that her formulation is okay for Norway. The two are close to each other. And the black one is if you impose US taxes. So you see that especially here at the bottom, there's a big difference between the two. And there would be less redistribution if Norway had US taxes. Of course, if Norway had US taxes, then these households would make different decisions and the general equilibrium would change as well. Here, you can think of it as a first step towards that. That's what we can do with our data. Now, if we redo the same estimate, look at this line in the middle, that's what we get with US data. So basically, we still wouldn't have amplification if Norwegian households paid US taxes. It would flatten out. So that's somewhere, if we had US taxes, our estimates would be somewhere between what we have and what comes out from labor income. The next thing we do is, of course, our MPC estimation is based on a shock that's not a transitory shock. So we re-estimate, we group people into quintiles of their income beta, and we do another type of MPC estimation based on Jean Comeau's method that builds on Blundell, Pistafer, and Preston. And what you see here, the blue is the original estimate with unemployment shocks, and the red one is the semi-structural estimator. It is lower, but not significantly lower across the bins. That's because the unemployment shock can be persistent, but it is flat across these bins. And finally, we calculate the aggregate MPC and average MPC. For Norway, the difference of the two is this covariance. So let's focus on, for the sake of time, on the covariance. If you calculate the covariance with labor income, you find a positive covariance, that's what you have seen on the graphs. If you add capital income, it's slightly lower, but if you had transfers, that's when it turns negative. And with the US counterfactual, it's also slightly negative. So to conclude, we find close to no amplification in this data set through unequal incidence. So through a recession impacting people heterogeneously, impacting their income heterogeneously. And the important metric for this measure is to use disposable income, not just labor income. I'd like to know that heterogeneity still matters, of course. There's still inequality in MPCs, and that matters for was the first step, the direct effect. But we find no amplification beyond that. And it's still important, you know, even though there's no amplification, that doesn't mean that policy doesn't have a role. Given the MPC heterogeneity, targeted transfers would still have a role. That's it for me.
The discussant is Morgane, Richard. Do I pronounce it correctly?
Yes, absolutely, Richard. Richard, thank you so much for having me discussing this paper. It's been a fantastic read. All right, so the broad perspective is that in the HANK literature, we do have a two-way feedback mechanism between the macro variables and the distribution of micro variables. And the amplification, you explained it really well, comes from the fact that in these models, we have these low-wealth households who are at the same time the most affected in recession, but also the most responsive. So the goal of the paper is to provide some measurement for this amplification. In other words, the question is, does heterogeneity amplify the aggregate effects of demand policies and shocks? How do they go about it? Well, they have this wonderful individual level matched data that have the personal characteristic, the income, the wealth, but also the consumption. So with this, they compute the distribution of MPCs, the elasticity of individual income to the aggregate one, and the elasticity of individual consumption to the aggregate one. Using this, they provide two sufficient statistics for amplification. The first one is the one that you're focused on today, but this is the one that is about income, and it's following also the method by Patterson 2023 of these aggregate MPC and the multiplier. The second one, I'll talk about it a little bit as well, is about consumption directly, the consumption beta, so it's about the cyclicality of consumption inequality, and it is based on a theoretical framework, a tank model. What do they find? Well, so they estimate some unconditional MPC of 0.38, so quite large. When we look at the first sufficient statistic, the one with respect to income, if we think about income as the way it's done in Patterson, labor earnings, we do have that the result of Patterson do replicate qualitatively, meaning that heterogeneity is responsible for some amplification. This is coming from the fact that the high MPC individuals are the one whose labor earning decreases the most in recession. This covariance is negative. When we look at the actual quantification, I'll come back to this, we're still quite different. But then what the paper does, and that's great, they rethink about what definition of income to use. And if we do the same methodology but think about disposable income instead, the result overturns, meaning that now heterogeneity is responsible for some dampening. And it's the case between the household with the highest MPCs whose disposable income decreases the least in a recession. Why so? Well, because of the automatic stabilizers, taxes and transfers. Now, they look at the second sufficient statistic, the consumption one, and when thinking about this consumption beta, they also find that heterogeneity is responsible for amplification, but quite mild, at most 12% in the worst episode, which is the Great Recession. Okay, what's the difference if we think about the amplification with respect to income or consumption? Well, this comes from the cyclicality of savings. All right, I think this is a fantastic paper on an absolutely first-order question. I think revisiting the MPC estimate with this wonderful data is great. You actually observe the consumption. You do not need to impute it. And not only that, but you jointly see this consumption, all the measures of income, the wealth, the personal characteristic for this high coverage of Norway. So this is great. I think this is super interesting that you find that still high income, high wealth households do have some substantial MPCs. And I really like the fact that you use different definitions of income, which is what we should care about. I think it's also nice that you have some theoretical framework, that guides your empirical exploration. So yeah, I'm really on board with this. Now I have a bunch of comments. The first one is more about the way you present your first result, the way you interpret it. And this is about the first sufficient statistic. So the whole story is like, okay, in Norway, we don't have a lot of amplification. If we do the way that it's usually done with labor earnings, qualitatively we replicate the literature, but then if we switch the definition, our result overturns and the new amplification comes from that. I do completely agree. It's an important factor, but I'm not sure it's the entire story. And I think if we look at when we compare with labor earnings, which is the same variable that is used in Patterson, the sign is the same, but the quantification is quite different. So this important variable, that is the covariance between MPC and the income beta, in Patterson is between 0.06 to 0.099, and you find 0.016, or ISO 17 in the new version. But so this is quite, there is still a delta, so we need to understand something else than using disposable income is potentially at play. Before coming to that, hold that thought when we are on disposable income, you're computing the disposable income beta at the individual level. And I think disposable income is a measure that makes a lot of sense when we think about at the household as a unit of observation, because some transfer are household specific, but also some tax, you mentioned the wealth tax. You do it a little bit in the appendix, but having maybe the main specification being that, I would have appreciated it, I think. Okay, so now we'll come back to our main question. There is low amplification. Part of it is due to disposable income. Part of it is due to something else. Maybe this is also due to the fact that you find your MPCs, if we look along the income distribution, are actually quite homogeneous, at least compared to what we have in the literature. Here, so I'm borrowing the plot from Patterson 2023 and from the paper. So this is the estimates of the MPC for different levels of earnings. So low, medium, and high income. And so they look different, but they should look even more different because the scale is different. So from Patterson, you go from 0 to 1, and from the HANKSSON, from 0 to 0.5. So basically, Patterson finds MPCs ranging from 0.2 to 0.9, and in this paper, we find it from 0.4 to 0.45. So we do have, maybe this is coming from the fact that we have quite homogeneous MPC in that direction. And potentially that's why when you play around with the US tax system, you don't find much happening. So this is about interpreting the results. And if this is the interpretation we take, I think I would like some discussion on some of the sample selection that potentially are consequential in this regard. So I'm doing durable consumption, so my first point will be about the fact that you do remove large purchases out of your consumption data. And I understand why you do this, but I don't think so. All the purchases above 12.5K in US dollars, I think this might not be totally neutral because you're probably removing a lot of durable goods, these large ticket items. And we've seen from the literature, for instance, the Orchard, Whelan, and Rame paper, that the MPC out of durable is the largest one, and this is driving the MPC estimates. So this matters for the levels, but I think it also matters for the distribution. Because when we think about durable consumption, we have these lumpy purchases in non-convex adjustment cost, and it interacts with risk. And so the risk and how the risk varies over the business cycle will be different where you are in the income distribution. So I think it also matters for like how different your MPCs are if you added this. The second thing, I'll be quicker on that, is you're also removing self-employed households, once again, for very reasonable measurement considerations. But I think these households potentially have low liquid wealth and would be the wealthy hand to mouth. So I would like to see a bit of a discussion to this. All right, my second comment is about the second sufficient statistic, and you said that quite a lot. It is model-based. And so it is derived from a TANK, so two-agent new Keynesian framework. And what I'm not sure I fully understand is how it can be fully generalized to a more standard HANK framework, in the sense that I think that in HANK models, one very important margin is how the expected intensity of the credit constraint varies over time. Meaning that if I'm an agent that's not hand-to-mouth, I'm on my Euler equation, But I still expect that in the future, I might become hand-to-mouth. The credit constraint might bind. And I take this into account when I make my consumption choices. And if this risk of becoming constrained is changing over the business cycle, I think that there would be some extra amplification. And I think your framework doesn't capture this, well, because in the main specification, the hand-to-mouth and the not hand-to-mouth can never move from one another. And you have an extension in the appendix, but the probability to become one or the other is fixed. So I think potentially having this margin, or at least discussing how generalized it can be. My last point on this is also, I would think it would be nicer to have a bit of a discussion of how to weave this tank with your empirical results, because in the tank, theoretically, the hand-to-mouth have an MPC of 1, the not hand-to-mouth of 0. And then in just above, you just computed these values, and you find 0.41 and 0.51. So it feels a little bit like, oh, but I just thought I read something else. So maybe discussing this, articulating this. And in the 30 seconds I have left, this will be the last point I have. So it's more about the interpretation. So heterogeneity, well, I think this is a very important topic. And I think you're finding at most this 12% amplification during the Great Recession. You're talking in the draft at least about quasi-irrelevance. I think 12% is quite relevant. So, so this is about like how we should read this result. And finally, maybe it doesn't matter so much for aggregate variables, but it will still be very consequential if we think about welfare. So I think it's important to keep maybe that in mind. And I am out.
Thank you so much for the wonderful discussion. At the moment, we are in the process of trying to understand why we get less amplification than in the US. And I think excluding durables is probably an important component of that, so we'll absolutely check that. Our goal was to come as close as possible to non-durable MPCs, but given that the other estimates in the literature are having the durables, and durables are like investment households, that's the first thing they cut in a recession. That's probably an important point. Thank you so much. Expected probability of becoming credit constrained, that's also something that's very important. Our analysis so far is very static, but of course there are dynamic impacts of demand shocks as well that we haven't checked yet. And there could be, we could check dynamic impact on consumption or IMPCs as well.
Thank you. So we can open the floor to questions. Helen, and then here.
Thank you. So I think it is a very, very important line of research, and so great session. And I also think it would be great to do that across the countries of the euro area, if it were possible. Obviously, for the ECB, that would be fantastic. I wonder if you could say a little bit more about the persistence of the shocks here, and because that may also affect, the time variation in this marginal propensity to consume. So you mentioned it a little bit, but I think it would be great. You do have a lot of information in this data, so maybe you can go a little bit farther on this. And then also what is very interesting is, in the comparison to the US, the access to credit, right? So the indebtedness of households. Can you say maybe also a little bit more along those dimensions? So probably the access to credit in Norway is quite different from the US. The role financial markets play with this regard would be also an interesting extension, I think.
Daria?
Thanks. I'm Daria Finocchiaro from the Swedish Riksbank, so a neighbor to Norway. I always think I have two comments, and then something also related to what Morgane said. One about MPC being so flat across different income in Norway. I wonder if you thought about the role of social insurance, if that could play a role. And here I'm thinking that One of my colleagues at the bank is working on papers showing that also ex-ante heterogeneity and exposure to risk matters for MPC. So it's not only about, so that could play a role and explain why you have flat MPC in Norway. And the other concern, if I recall right in one of these thousands Norwegian papers, this very great data that I saw, shares of hand-to-mouth don't vary so much over time. So in a sense, it's like if that doesn't change so much over time, it's not such a, to take a tank approximation is not a big problem. It would be much a big problem if shares, of course, varies over time. But maybe, yeah, so that's.
You want to take this and maybe we have another round?
Yeah, so the persistence of shocks, typically if someone becomes unemployed, it takes about a year to get back to the previous income level. That's also coming out from an estimate of a paper by Fagereng on how much people consume with imputed consumption from an unemployment shock. So in the COMO estimates, COMO BPP estimates, we take that into account. So we take into account the persistence of income when we calculate MPC. And that's why we have slightly lower MPC estimates with their method. But the important message from there is that it's still a flat distribution across income betas. Access to credit, it's quite easy to access credit in Norway. Let me just say that for the sake of time. So that's a potentially very important difference between the US. Flat MPC could be a result of social insurance, but I think an important finding we have is that it's not just social insurance, but it's capital income as well. Capital income has an important role in flattening this curve and lowering the covariance. Share of hand-to-mouth households and how that evolves over time. We started looking at that. I can't say a lot. It's quite a persistent state, but there is also time series variation in recessions. There are more hand-to-mouths.
So I want to give the last question.
Yeah, just two comments. So there's I just to reinforce what Morgane's point about the cyclicality of risk, because there is cyclicality of inequality, which was you focus on, but the cyclicality of risk is quite important. And as we show in our paper, the unemployment rate may generate a lot of amplification. So that's something that I think it's absent from your analysis. The other comment is just about a little bit, maybe I'm wrong, but about the narrative. Because you say heterogeneity, once you look at disposable income, dampens. But shouldn't we rather say heterogeneity amplifies, but then counter-cyclical policy does what it's supposed to do, right? Not only stabilizer, but also counter-cyclical policies, and they then, it's not that heterogeneous. So this is just about language, but I think the message you gave is very different.
I like your language. It's almost like a proof of concept. Good policy works.
And this can also be discussed further at the break. Thank you very much for a very interesting session.